Welcome back to the deep dive. We've just gotten our hands on a stack of institutional reports, the kind of stuff the big desks use, and frankly, they're telling us completely different stories about the S&P 500 right now.
They really are.
So our mission today is to cut through that noise, figure out which story is true, and give you a shortcut to what's actually happening.
Yep.
We're doing a deep dive into the mechanics of high-level trading, and we're focusing right in on the S&P 500 futures, the ES contract, specifically for Wednesday, January 14, 2026.
And this is really a moment of absolute truth for the market. We're unpacking how professional traders are looking at what we're calling the 7,000 wall.
That big psychological number.
Exactly. It's a psychological and technical ceiling, and we're looking at it using hard data,
Yeah.
price action, yields, and, the hidden institutional positioning.
So what does the tape tell us right this second?
The tape says we're in a fight, a really tight battle. Right now, pre-market, the price is hovering right around $6,990.000. So close. The market is in what we call bullish consolidation. It's basically a digestive phase. The market is just catching its breath after that incredible run up to the all-time high of 7,036.
The trend is still up, but the momentum's gone.
It's stalled out completely. It's like watching paint dry, really, just waiting for the next spark.
And that spark is exactly what we have today. Not one, but two huge catalysts set to drive volatility.
Huge.
Yesterday, we got that Goldilocks CPI data. Core inflation came in a bit softer than expected, plus 2.6%. That keeps a hope for a rate cut alive.
It does, but that relief was, well, it was immediately challenged by earnings. JP Morgan missed their numbers yesterday, and that put a huge dent in the entire financial sector.
Right, and today's the main event, bank earnings part 2.
This is it. We have Bank of America, Wells Fargo, and Citigroup all reporting pre-market. So the market's direction today, despite that good CPI data, it's completely hostage to whether these banks can calm the fears that JPM started.
Okay, so a clear battleground is defined. What's the fundamental swing thesis here? Do we bet on the macro news, or do we run from the weakness in financials?
Well, the micro environment, the inflation data, the economy in general, that's providing a bullish tailwind, no doubt. But the immediate price action, it's just hostage to these banks.
So what's the plan?
The plan from our sources is to stop guessing and start stalking the breakout. That means you watch the defined range like a hawk. 6,935 is our floor, 710 is the ceiling. We need a clean, convincing close outside that box. That's what confirms the next big move.
Okay, let's unpack those big picture environmental factors first. We call this our go-no-go gauge. It tells us if the whole foundation for this rally is actually safe.
And we have to start with interest rates. The most important metric here is the 10-year Treasury yield. Think of this yield as the market's governor.
The governor.
Yeah, if it gets too high, it acts like a giant vacuum cleaner. It just starts sucking money out of stocks because suddenly safe bonds look really attractive. And at the same time, it threatens stock valuations.
So where are we with the governor right now?
Right now, we are at 4.18%.
And that's good for us.
That is a massive green light.
Okay, why?
Because yields have cooled off significantly after that soft CPI report, it's pulled us back from that really critical 4.25% danger zone we were all watching.
And why is that specific number, 4.25%, why is that the invisible line in the sand?
It's all about valuation math. The S&P is currently trading at, roughly a 22 times price to earnings multiple.
Which is pretty rich.
It's very rich, and that valuation is only sustainable if the cost of money represented by that 10-year yield stays contained. If the yield spikes over 4.25%, analysts have to start aggressively discounting future earnings. It's just math.
And that would threaten the whole 22x multiple.
Immediately. It creates a structural headwind for the entire index. So 4.25% isn't just a number, it's the tripwire for a major S&P valuation correction.
Okay, so the environment is safe for now, but here's where it gets, I think, really interesting. We have a major health divergence when you look at sector rotation, the market's engine.
It's like having one strong cylinder and three weak ones.
Exactly.
Technology, especially the heavyweights like NVIDIA, AMD, they remain incredibly resilient. They're acting as the main pillar holding up the whole S&P.
But the financial sector, if you look at the XLF ETF, it's under heavy pressure.
Oh, heavy distribution. Between the JPM earnings miss, which hinted at credit distress, and then these regulatory fears about credit card rate caps.
It's getting sold off hard.
Right. And this divergence is the market's core caution flag. For us to get a healthy, sustainable breakout above 7,000, you need broad participation. If it's only tech driving the bus while financials are actively dumping stock, that breakout is just built on quicksand.
It's prone to failure.
Extremely prone. The moment tech takes a breather, the whole thing could unravel.
So if the underlying health is mixed, that makes me wonder who is actually selling up here near 7,000. Let's look at the institutional footprints, the smart money versus the dumb money.
Okay, for this, we use the Commitment of Traders report, the COT report. It shows us what the commercials are doing, the big hedgers, the banks, the manufacturers. These guys are generally considered the smart money because they're hedging actual fundamental risk. They're not just speculating.
And what are the commercials doing at 7,000?
This is where it gets fascinating. It's a huge contradiction. While we're sitting here talking about a bullish consolidation, the commercials are net short. And not just short, they are positioned near historical extremes.
Oh.
They are aggressively hedging this rally. It tells us the world's largest, most fundamentally driven players are treating 7,000 as a structural cap on fair value. They're essentially betting a correction is coming.
Well, it's a huge contradiction. If the macro environment is a green light and we're in a, quote, bullish consolidation, doesn't the fact that the smart money is this short, doesn't that undermine the entire bullish argument? How do we process that?
That's the key question. It doesn't undermine the trend, not completely, but it severely limits the speed of the ascent. So the tangible impact for you as a trader is that you have to expect grinding price action. Any fast vertical move up, the kind that gets retail traders really excited, is very likely to be sold into immediately by these huge institutions. It just keeps a lid on things.
A powerful ceiling on price. So let's look at the other side of that coin, open interest analysis. This tracks a total number of outstanding futures contracts. And the data shows open interest actually went down slightly during that rally, from 6,900 to 7,036.
And that small detail is a huge clue. It connects directly to what the commercials are doing. Declining OI during a rally means the move was mainly driven by short covering.
Not new buyers.
Not new buyers. It was people who were already bearish being forced to buy back their positions. It wasn't fueled by massive amounts of new money or new buying coming into the market.
So if the rally was driven by short sellers panicking rather than new bulls stepping in with conviction, what does that say about the rally's strength?
It tells us the rally is fragile. We often say a short covering rally is like climbing a ladder that's missing a few rungs.
I like that.
It can be fast, sure, but it lacks that institutional conviction of new cash. So if the news turns negative, say, if today's bank earnings bomb, that fragile rally can reverse extremely quickly and violently because there's no deep pool of fresh buyers there to cushion the fall.
Let's define the boundaries now, the magnetic levels, the invisible walls where price is going to stall or reverse. This takes us into the options market structure.
Right. First, we check the VIX. It's at 16.4, which is a little elevated. This signals what I'd call cautious optimism, not complacency.
So people are buying protection.
Exactly. The fact that the VIX is above 15 before major earnings means the pros are buying puts, they're hedging, they're not betting on a totally smooth ride here.
Okay, now for the walls. Where are the option dealers doing the heavy lifting?
The primary resistance is the call wall, and it's sitting up at 7,050. This is the first invisible boundary.
And what does that mean in practice?
At 7,050, there's a massive amount of open interest in call options. So the market makers, the dealers who sold those options, they will defend that level aggressively. As price gets close to 7,050, the dealers have to sell futures contracts to stay delta neutral. It effectively creates a ceiling where all that buying pressure just runs into a wall of institutional selling.
And on the downside, where's our floor? The panic level.
That is the put wall. We call it the hard deck. It's at 6,900. If price were to break cleanly below 6,900, it triggers an algorithmic cascade.
How so?
The dealers who sold all those puts are suddenly forced to accelerate their selling of futures to hedge their new risk. That forced massive dealer hedging would just dramatically accelerate any correction. 6,900 is the red line.
Right in the middle of all that, we have the daily pivot at 6,980. How does that define our immediate zone of control?
It's the short-term scoreboard for today. Above 6,980, the bulls have control, and we're probably drifting back towards 7,000. Below 6,980, the bears are in control for the short term, and we're likely to drift down and retest support around 6,950.
Okay, shifting to pure technicals now. The daily moving average stack looks pretty healthy. Price is above the 20-day, which is above the 50-day. The trend's intact. And that 20-day SMA is sitting right around 6,940.
And what really stands out there is the evidence of conviction. We already tested that exact area yesterday. We hit a low of 6,945 and bounced immediately.
So dip buyers are active.
Very active. And they're dedicated to defending that major moving average. If that 20-day fails, that's when you know the conviction has really shifted.
Speaking of shifting conviction, we have to talk about the biggest warning sign on the charts, momentum divergence. We're in this high-level consolidation from 6,935 to 7,010, which is normal, but the RSI, the Relative Strength Index, is flashing a big caution sign.
This is a huge, subtle clue for you to watch. Price made a higher high at 7,036, right? But the RSI, which measures the strength of that move, failed to confirm it. It made a lower high.
What's the analogy there? What does that divergence signal in plain English?
It warns of exhaustion. It's like you're hitting the gas pedal on your car, and the speedometer keeps climbing, but the RPM gauge, the engine power, starts falling.
Ah, okay.
It means the engine of upward momentum is weakening even if the price is still high. The move is running out of fuel, which makes it highly susceptible to a sudden drop if these catalysts turn negative today.
Okay, we've synthesized the macro outlook, the institutional hedging, the technical walls, and that big exhaustion warning. Let's turn all of this into a concrete 3-day trading plan, all centered on these bank earnings. What is scenario A, the earnings relief path?
This is the higher probability bullish scenario. It requires the BAC and WFC earnings to be good enough. They don't have to be spectacular, just reassuring. And crucially, the 10-year yield has to hold below 4.20%.
And what's the specific action trigger we'd be looking for?
The trend says stay long, but you need confirmation. The trigger is a clean 15-minute close above 7,005. That proves we've definitively reclaimed that key psychological level.
And if that happens, what are the targets?
If that happens, target 1 is the 7,036 all-time high retest. If we can break that with some force, target 2 is up at 7,080, which is a pre-calculated Fibonacci extension level.
And given all the warnings we just talked about, what's the probability forecast for that bullish breakout?
Given the divergence and the COT data, we're putting that at about a 35% probability. It's definitely possible, but it needs a really strong positive catalyst from the banks to overpower that technical exhaustion.
Okay, now for the protection play, scenario B, the 20 SMA flush. This is what happens if more banks miss or give weak guidance and we lose that critical 6,935 floor.
Right. If that 6,935 support breaks with conviction, with volume, the algos will immediately flip to neutral or sell. Your action here is rapid risk management. You liquidate any swing longs you have. Period.
And for anyone looking to capitalize on that move down, what's the safest entry for a short?
Do not chase the break. Wait for the market to fail. The entry for a short position is on a failed retest of 6,935 from below. If price tries to bounce back above that floor and gets rejected, that's your confirmation. The breakdown is real. The downside target then becomes 6,880, the previous major breakout zone.
And the probability of that bearish breakdown?
And we currently assign that a 20% probability. It would take disastrous earnings or a sudden spike in yields back toward 4.25% for the market to give up this structural floor.
So if the bull case is 35% and the bear case is 20%, that suggests the highest probability for the next few days is just
range chop. Exactly. The highest probability forecast, 45%, is that the market just continues this high-level consolidation between 6,950 and 7,000. It's waiting for definitive clarity after all the earnings are out. We are in a structural digestion period, and until a major catalyst forces a resolution, you should expect tight, choppy, volatile action. Look, the final takeaway for you today is the story of this market's resilience. Despite those poor JPM earnings yesterday, the market refused to drop. It held that 6,935 floor in the 20-day moving average. That refusal to sell off is a really critical, hidden bullish signal. But you have to respect that 6,935 floor religiously. Losing that floor changes the entire game.
That brings everything into perfect focus for the open. For you, the listener, the two critical numbers to watch today as the market digests these bank reports are 7,010 for confirmation of strength and 6,935 as that critical floor, the line between healthy consolidation and the start of a deep correction.
And this raises one final provocative thought for you to mull over, especially given that contradiction we found with the institutions. We know the smart money, the commercials, are positioned net short, near extremes. They're betting against the 7,000 level. So how quickly might the price move up if today's bang earnings surprise to the upside and force those highly leveraged institutional hedgers to aggressively cover their shorts?
A massive short squeeze.
Exactly. Remember that short squeeze risk inherent in the COT data. That's often the hidden fuel for the most violent, most unexpected upside moves. Something to think about as you watch the price action today.